Sam Burns, Chief Strategist of Mill Street Research. Thank you so much for joining me and welcome to the show. It's so great to have you.
Oh, thank you, Julia. I appreciate it. I'm looking forward to it.
Well, I'm looking forward to it as well. And I was hoping maybe we could kind of start with a bit of your own background. I know you've been in this business for many years, and I was hoping maybe you could just share a bit about your background, Sam, and also share a bit about Mill Street Research.
Sure. So, I started doing kind of, market strategy, looking at, markets and, writing research about, stocks, bonds, different assets and stock selection primarily. About 25 or more years ago, after I graduated from Vanderbilt with an economics degree, I did a few years in Nashville, and then went and got an MBA at the University of Texas, and then went to work at Ned Davis Research down in Florida, where I've did a lot of work, building models and things like that, which I've continued to do over the last 20 years or so. And so I went from there to a few other firms up here in Boston, and then about 7 years ago now, I decided to break out on my own and start Mill Street Research as an independent research firm, where I could do more of what I wanted to do without any kind of bureaucracy and committees or potential conflicts of interests from investment banking or trading or any of that kind of thing. So it's been nice to be able to take all the work that I've done and everything I've learned over the last 25 years or so and put it all together into a research product that I can offer however I want. So it's a lot of flexibility and fewer constraints than I've had for most of my career. So it's been the upside. Certainly having to be in charge of everything is potentially the downside, but it's worked out well so far, and I'm definitely enjoying it. So it's been a lot of years and a lot of watching markets and trying to build objective indicators to help guide what I do and what advice I give to clients, rather than kind of being tossed around by the headlines every day. So that's a lot of what I focus on.
I love that. And like just hearing you say like having like the flexibility to do the things that you want to do or the research that you've always wanted to do. And I got to say, I'm a solo podcast host. And so I get to have amazing conversations with folks like yourself that maybe I wasn't able to do when I was doing more like mainstream financial media. So it's really fun. And I love hearing that you kind of get that freedom and flexibility too. I want to, pull out a few things in your answer just to explore a little bit more. What were some of the things when you're saying like more flexibility or getting to do the things that you want to do? Help me understand, like, what were those things? Like, what is kind of your approach or like the more of the research that you wanted to do? What was that?
Right. So a lot of what I've done since I've been at Mill Street Research in particular has been trying to combine basically top-down analysis, kind of macroeconomic work, that kind of thing, and what I call bottom-up, meaning data based on individual company analysis, kind of the earnings estimates, the valuations, price trends of all the individual companies globally, and trying to see where those two things align. So if you're seeing something in the GDP data or inflation or retail sales or interest rates, and then if you can look kind of down underneath the hood and see if analysts say are raising estimates in a particular sector or in a particular region to corroborate what you're seeing and kind of at the high level, then you usually get better signals and kind of better information when those two things align. And so I think a lot of what happens in Wall Street is that you get kind of bucketed into either being a macro person and it's all top down and kind of macro data, or you're, say a quantitative analyst or a fundamental analyst, and you're really looking only at the stock specific individual company data. And it's hard to find between places where you can really align those two and merge them and look at individual companies, then industries as a aggregation level, then sectors and countries and regions, and then up to the level of kind of the major macro data. And that's a lot of what it's found harder to do when you're kind of forced to be sort of pigeonholed to some degree at a typical Wall Street bank. Also, then of course, like I say, There's no other, parts of a firm, whether it's investment banking or trading or anything else, to tell me, well, we don't want to say bad things about this company, or we want to be bullish all the time because that's what is better for, other parts of the business. I can be bullish or bearish on anything I want, anytime, and not have to worry about, what the implications might be for some other part of a big bank or something. So those are really the key aspects of being independent that appeal to me.
And you know what? I got to say, I bet it appeals to the viewers too, like getting that, that real take from you, that you could be bullish or bearish or, whatever you want. Let's talk about the big picture. Usually that's where I kick things off on this show, is the big picture, the macro view. We can kind of separate it too. Like, let's start with the economy, or what's your big picture macro view today? What are you thinking about? What are you kind of paying attention to?
Yeah, I think it's definitely been a difficult time for macro analysis the last few years, just because of COVID and all the after effects of that has made a lot of the data harder to interpret, and certainly a lot more volatile than it normally would be. So a lot of what historical cycles look like in macroeconomics don't apply as much right now, just because everything is much more compressed in some sense, and distorted by both COVID itself and then the policy responses to COVID that's have happened over the last couple of years. So a lot of the kind of you're looking at a chart and you see the scale is the normal range before COVID. All those scales are kind of blown out in a lot of ways. All the peaks are higher and the troughs are lower, and it's much harder to get a clean read on what's going on. And even government data statisticians have had trouble kind of keeping up with it all. And so I think it's important to look at a broad variety of data and not get too hung up on any particular data series, and certainly not the month-to-month data that we see, which is still very noisy and requires a lot of adjustments and interpretation. So my general overall picture is that the economy is doing okay. We're probably in the process of slowing down from the very strong kind of stimulus-driven activity we saw the last couple of years. I think the labor market is certainly a source of strength. Things like the housing market is probably a source of weakness. But I think overall, we're probably in a kind of a slow growth environment right now. If you look at real activity, if you look at kind of the nominal data, meaning including inflation, it still looks pretty strong. But inflation is probably coming down still from higher levels. I think the last probably 6 months or so, it's definitely decelerated. And so the big question now is how policy is going to respond to that, the Fed, and to some degree fiscal policy. So I think I don't think we're heading for an imminent recession. I think a lot of people kind of came in late last year looking for a recession this year. I think that's at least being put off, if not delayed until well, and maybe into next year. But I think a lot depends on what the policy responses are going to be. So I think if the Fed can avoid over tightening, and if fiscal policy remains at least somewhat supportive, we could probably get through this year without a recession. Mm-hmm. And I think things like energy prices are going to be helpful for that. They've come down quite a bit, and certainly they're helping Europe a lot. I think if China can kind of get through its COVID issues and be a little more stable, that will help. There's a lot going on globally, but most of it is in a kind of a decelerating stage. And certainly monetary policy, generally speaking, in the U.S. and Europe is tightening. So that's going to kind of keep things under pressure. So I think things are not going to be as bad as a lot of the real bears and the negative kind of doomsayers have been saying. And I think the market got priced for a lot of that late last year. So I think there's a difference between what was priced in and what's actually happening now, in the sense that it's not great, but it's not as bad as expected. And that's really the key thing for me, is to see, is it really as bad as people were expecting it to be? And I think the answer is no.
Yeah, that was such a great way to frame up this conversation, and more things I want to tug on a little bit too. You're right, because there was a lot of pessimism end of 2022, where it almost felt like the consensus was that we're going to have a recession. And what I'm kind of hearing from you is that doesn't look imminent, or at least it could be put off or delayed until next year. So I guess my follow on is on the recession narrative, what do you think changed? Or how has that shifted? We're only 2 months into the year. What do you what was it that changed?
I think to some degree, people assume that the Fed's interest rate hikes that had happened, all last year and are going to continue into this year would have a bigger impact on the economy than they have so far. Now, nothing to say that they couldn't suddenly have a sudden, big impact and really slow things down more dramatically, in the next few months. But right now, it looks like people underestimated how resilient the economy could be to Fed interest rate hikes. And I think part of that is because the last time the Fed did something like this was the 2005, 2006, 2007 period leading up to the great financial crisis. And then the impact was quite dramatic, of course. But back then, the economy, I think, was more sensitive to interest rates. There was a lot more leverage in the system, both in banks and the corporations. And there was, and certainly in the housing market, and the mortgage market. So a lot of those things that caused the economy to be more sensitive to rate hikes in the last cycle are less so now. And a lot of that is because of the fiscal stimulus, the fiscal support that was put into place after COVID, that's kind of had a long tail to it. That even though most of the fiscal stimulus stopped a year and a half ago at least, a lot of the stimulus checks and extra unemployment benefits and all those things have gone away for a while. A lot of that money that kind of got distributed is still floating around. It's still, consumers still have some of it. Some local and state governments still have some of it to spend. And so I think there's been a fiscal support that's helped offset part of what the Fed has been doing in terms of raising rates. So even though mortgage rates are way up from where they used to be, and the housing market has slowed down, other parts of the economy are holding up better than people anticipated. I think it was kind of looking at the last cycle and saying, oh, well, the Fed's hiked rates very aggressively, the economy will then immediately fall apart. Well, it might, but it hasn't yet. And I think some of that is due to the lagged effects of the fiscal stimulus that are still there, and the fact that the fiscal policy is still, I would say, somewhat supportive, meaning that there's still the Inflation Reduction Act and some of these other things that have been passed for infrastructure and things like that more recently are still having some supportive effect to offset what the Fed has been doing. And so it's not been a combined effect of the Fed and fiscal policy both tightening at the same time. Fiscal policy is tightened from where it was after COVID, but it's still not extremely tight by most measures. So I think that's been a unexpected benefit this cycle relative to past cycles that a lot of people have overlooked. And I think the U.S. consumer still has income to spend. The job market has been holding up quite well, and that's, I think, the key kind of core driver there of keeping consumer spending up, where people are not so far losing their jobs. They're still getting jobs. They're still getting wage increases, even if at a somewhat slower pace. And that's the key driver of 70% of the U.S. economy. Mm-hmm. So I think those are kind of the key reasons why the economy's held up so far and has enough momentum to carry us forward, at least through, say, mid-year, if not a little farther, before you start to see further slowdowns.
Yeah. Why do you think the labor market has been so tight? Like, why do you think it's held up? And at the same time, and maybe it's the thing you have to separate, but you see the headlines, the first month of the year, we saw a lot of, big headlines in the financial media about big tech layoffs. You could name a bunch of different tech companies with layoffs. I'm just curious, your thoughts on the labor market, why it's remained so resilient.
Well, I mean, the way I kind of look at it, big picture, is that if you think of the supply disruptions that happened due to COVID, most of the supply disruptions that were caused in the sort of the goods producing market, manufacturing and shipping things from China and all those kind of things, a lot of that has been resolved. But the supply component that has not been fully resolved is labor. So in addition to, of course, losing a lot of people due to COVID directly, and then people who have become unable to work or unable to work the same jobs due to COVID, you've also had a much more restricted immigration policy in the U.S., both due to policies that preceded COVID and due to COVID itself, closing the borders and things like that. So a lot of the supply of labor that would normally have been there is not there, and it's hard to replace quickly. Now, there's certainly things you could be done with immigration policy that would fix that, but we're not doing them. So I think the labor supply issue is still kind of the key, limitation on growth and on sort of supply overall. And that's why you're seeing the inflation in services, for instance, holding up a lot higher than the inflation in goods prices, where things have already really slowed down quite a bit. And so I think that's the supply demand dynamic in labor is still limited by the supply constraint, and the fact that there's still money to be spent means that the demand supply kind of balance is still somewhat tight in the labor market in the U.S. for sure. And so I think that's keeping wages and job growth up, and there's still that kind of a longer term catch up from where we were prior to COVID to where we are now. We're sort of just now finally really catching up in terms of labor force participation and those kind of things, getting people who had fallen out of the labor force back into it one way or another, either due to reduced exposure to disease, or people who had maybe decided to retire, trying to come back into the labor force. All those things are take a long time to play out without the kind of support from either immigration or new demographics, domestic growth in the labor force. And so that's, I think, keeping the labor force relatively tight, and therefore you're keeping wage growth up. And I think businesses also are kind of hoarding labor a little bit, meaning they've found it hard to hire. And so even if things slow down a bit in terms of business, they don't want to let people go too quickly for fear of not being able to find them again. Now, you mentioned a lot of the tech layoffs. I think those have been more specific to that particular kind of industry. A lot of those companies hired aggressively in the last couple of years, to almost record degrees in some cases. And so I think there was just a lot of overhiring in some cases for some of those companies. And as it turns out, they get a lot of press, they get a lot of news, but they're not a big percentage of the overall U.S. labor force. So the overall aggregate impact of some of those layoff announcements, as you've seen, is not huge in the context of a large U.S. labor force. And a lot of those people are actually finding new jobs fairly quickly. So you're not seeing the unemployment claims go up dramatically, even though you're seeing the layoffs. And so there's a lot of indications that those people who are being laid off are finding new jobs, and they're not a big percentage of the overall labor force so far. So I think, generally speaking, those it's more more headlines than a real underlying trend of weakness.
Yeah. I want to also ask you about inflation, because you did bring up inflation there, specifically around like services. We got the CPI report, or the latest one. Like, help me understand like how. And I haven't gotten to read all your research, but like, how have you been thinking about inflation, or how do you continue to think about it, or what's kind of top of mind for you as it relates to inflation?
Right. Well, I think the key things about inflation are, one, keep in mind that it's still hard to measure. And so, one of the things that came out in the CPI report just recently for January was a lot of the historical data was revised because of the, just the way they construct the indices and revise data based on either seasonal adjustments or new data that's been, accumulated since then, and new weighting schemes for the data. So, you have to be careful about overinterpreting any of the data too much. I think the general big picture trend is that inflation accelerated quite aggressively in kind of late 2021 and through mid 2022. So it's kind of June, July of 2022 is really where a lot of the data peaked, in my view. And since then, it's been a decelerating trend, not deflation, but disinflation, meaning a slower pace of inflation since kind of mid-year of last year. And you can see that most directly in commodity markets, for instance, which is one of the things I look at, because it's often very sensitive to global supply and demand. It's also the easiest thing to measure in a lot of ways. A lot of what goes into the CPI and other measures is kind of extrapolated data, are harder to measure accurately over time. Whereas commodity prices like oil or metals or food, the way they are in commodity markets, are pretty much the same thing month after month, year after year, and you can track them very accurately. So that peaked middle of last year and has been basically trending lower. And that reflects both the effects of COVID and supply chains, but also the response to Russia's invasion of Ukraine and the effects on oil prices, which basically peaked middle of last year. So I think that tells you that the underlying, kind of supply dynamics have improved for a lot of the goods producing side of the economy that rely on commodities as inputs. And that's why you've seen goods prices really moderate quite a bit overall. And so it's really only the services component that has really held up the inflation numbers so far. And part of that in the CPI is, of course, the shelter, the housing kind of rent costs. And there you have the issue of things have basically moved faster than the CPI was designed to capture. That the shelter component of the CPI is lagged by construction, meaning it only moves, it only adjusts incrementally to changes in rent prices and home prices, because they assume, of course, that most people don't move or refinance or get a new lease every month. They only maybe once a year would you say, re-up your lease for an apartment, for instance. And so that's the way the CPI is constructed, which makes sense in some ways. But because prices have moved so fast, rents are already falling, or at least decelerating rapidly. Home prices are falling, but that is not yet represented in the CPI data. So it will be later this year, probably, as the data kind of catches up. But that effect is having a big impact on what you see in the headline CPI data. Now, most economists and the Federal Reserve are aware of this and can adjust for that to some degree. So even if you take that out, there's still some pressure on services prices. Most of that is because of the labor market. People are having to pay up for workers at restaurants and hotels and things like that. And I think that's keeping the services side of the economy, inflation there, up, whereas goods have to a large degree slowed down. I think that's the hard part for policy, is knowing which of those two things to pay attention to most. So I think we're waiting for the services to kind of slow down before policy will ease. But I think it's a less of a problem right now. I think the general trend is for deceleration. There's a lot of month-to-month noise, but I think you're going to get more deceleration in inflation as you get closer to mid-year. Mm-hmm. And then probably by the second half of the year, the numbers will look a lot better.
Yeah. I don't know if you ever, I don't know if you put this out there or write about it or whatnot, but do you think that we can get back to that 2% target? Is it realistic? Or do you think that maybe we have to kind of rethink what the target looks like, or what, I guess I don't know. What do you think? Or what's kind of your expectation of where we could get to as it relates to inflation?
Right. Yeah, and that's been a big topic, certainly for Fed policy, is to say, what is really the goal and what's realistic, over say the next 3 to 6 months versus say the next 2 years. And I think eventually we will get back down to kind of close to that 2.5% inflation rate that we had, for a long time pre-COVID. I think a lot of the long-term kind of secular drivers of inflation are still kind of in the downward, trend. I mean, for subdued inflation, I think demographics are a big part of that, and technological productivity growth is still there. All those things tend to be disinflationary, but I think it's going to still take a while to really get through all of the lag kind of knock-on effects from COVID and all the policy responses to it, and the way policymakers have rethought things a little bit. So I think it'll take a while to get back to that real 2% sustained. I think probably by the end of 2023, we'll be a lot closer to that. Maybe it's 3% or the high twos. But I think the Fed will probably be okay with that. I think they're probably going to allow a little more flexibility once we get down into, below 4%, certainly, and maybe below 3.5%. They'll figure that that's probably, close enough for the time being. So I think, the Fed is probably not going to officially change their, 2% or 2.5% target, because I think just from a, credibility standpoint, they don't want to be seen as moving the goalposts. But I think realistically, over the next, say, 12 to 18 months, that, a slightly higher rate of inflation is going to be acceptable for a lot of people. But I think a lot depends on what fiscal policy winds up doing. I think if fiscal policy becomes significantly tighter, if the fiscal U.S. Treasury deficit goes down a lot more, that will put further downward pressure on inflation, and probably might get us there somewhat quicker. I think that would probably be negative for the economy overall, but I think that would push inflation lower. I think the Fed is really trying to wage a war of kind of perception right now. I think a lot of what they've done is probably sufficient. Rates near 5% is probably enough to bring inflation down over the next, say, 6 to 12 months. It's just a question of how fast do you need to see the progress, or before you raise rates further, tighten further. I think that's really the question for investors' minds is what is the Fed's response going to be to the inflation data that we see over the next few months, just because it is going to be a bumpy road back down to kind of that 2% level.
Yeah. Just another quick follow on, and I'm taking notes too, and it's so helpful. And I'm so grateful to have you on, Sam, because this is really interesting stuff. I want to hear a bit more. You just mentioned about like pushing down the deficit and the impact on inflation. Can you just explain that real quick for me? Because I'm sorry, like I kind of missed the essence of it. I just want to hear a little bit more.
Sure. So I think a lot of people, certainly in the markets, get really focused on the Fed and interest rates and their balance sheet and all these kind of monetary policy variables, and haven't maybe focused enough on the fiscal side of the equation. There's sort of two big drivers in terms of policy that really affect a lot of what's going on in the markets and the economy. And the fiscal side, has had a huge impact, certainly post-COVID, comparable to what happened during World War II, arguably. Now that's really started to fade a lot, but is still there. And I think a lot of people, when they think about what drives inflation, there's sort of people think about printing money and kind of the money generation process and kind of where does that come from, and they tend to think of the Federal Reserve and the banking system as being the driver of that, and they are in a sense, but the real kind of money printing comes from the Treasury, the U.S. federal government, in the form of deficit spending. Essentially, whatever is spent by the federal government that is not taxed away, returned to them in the form of taxes, which is essentially the deficit, is the amount of money being put into the economy on a year-to-year basis. And now how it gets spent and where it goes and whether it causes inflation or not can be a little more complicated. But at a high level, that's kind of what drives the measure of fiscal policy that I tend to look at a high level. And so if you think the federal budget will kind of stay more or less where it is, kind of maybe a 3 to 5% of GDP being the size of the deficit, proportional to GDP, that would probably be in line with history and probably be somewhat supportive for the economy and keep inflation at a moderate rate. If you thought fiscal policy was going to be much tighter than that, meaning we're going to go for a much lower deficit relative to GDP, which certainly given the split Congress now could happen, that would mean a more kind of tighter contractionary fiscal policy that would probably put more downward pressure on overall growth and on inflation, and that would then kind of combine with the tighter monetary policy to really kind of tighten policy and reduce inflation more quickly. And so I think it's important to keep in mind what is fiscal policy doing, how big is the deficit essentially relative to GDP, and then to some degree where is that money getting spent, how is it being allocated across the economy or globally. We saw the biggest direct effects after COVID when the government, the Treasury sent checks to everybody directly. You just showed up in your bank account, you didn't have to do anything, or unemployment benefits that were increased and extended. That was a very direct way of implementing fiscal policy that was really not done much before. We've kind of, a lot of that has gone away, but there are still forms of stimulus that can be used. And again, the infrastructure spending or other kind of policies that have been put in place, those are all going to have impacts on the economy, on inflation over the next few years. But once they get passed and they kind of the news, they go out of the headlines, then people kind of go back to worrying about the Fed, which is more of a day-to-day thing that you can see in the markets. And I think it's important to keep in mind, kind of on the longer term basis, what is fiscal policy doing? I think that looking at something like the debt or deficit to GDP ratio as kind of a rough proxy is a good way to track that. That's something that I talk about in my research periodically, is to keep that fiscal side of things in mind. It doesn't have a day-to-day impact, but it does have a kind of an intermediate term impact that's at least as important as monetary policy.
Mhm. When you bring up the deficit, it also makes me think of like the debt and the debt situation in the US. I don't know if that's something you think about or focus on either. But do you have any thoughts there? Or is it something that comes up in your research ever?
We do get questions about it periodically, and certainly right now, the debt ceiling debate in Congress is big news. This has happened before, of course, and the normal kind of way it plays out is that after some theatrics and potentially some concessions in a budget or something, the debt ceiling gets raised and things kind of go back to normal. I think most economists would agree that the debt ceiling itself as a concept is sort of silly, in the sense that once appropriations are made and the budget is constructed and money is spent in the form of the deficit and the difference between taxes and revenues and spending, then a debt ceiling is sort of doesn't really make sense. But I think the idea is that it may produce some reduction in spending or increase in taxes or some other way of reducing future spending, and that's really going to be the impact that I'm looking for. The level of the debt itself, however many trillions it might be, is less relevant overall. It can have some impact in the sense of interest expense and how money gets allocated in the economy, whether it's going more to savers or to consumers, and kind of the way it affects the relative proportions of income from interest or dividends or wage income, things like that. But overall, the debt itself, I don't think is a real problem. And I think as long as the deficits that are produced, by the at the fiscal level every year are in that kind of 3 to 5% of GDP range, I think that's probably that's historically normal and probably fine, and probably what we should be aiming for. I think a balanced budget in the sense of zero deficit would be detrimental. I think that would be quite contractionary, because that would mean that if the economy grows, there's no extra money to support it. And so I think that's there should be a certain level of deficit, generally speaking, at the federal level, in order to accommodate natural growth in the economy, whether from population growth or productivity growth or whatever it might be. So I think it's on a long-term basis that's easy to forget. But the federal government, the Treasury, needs to produce more money for the economy every year to keep up with natural underlying real growth. Otherwise, you get deflation, which you probably don't want either. Yeah. So I think the important thing is to kind of watch the deficit to GDP ratio, that kind of number. The overall debt level is less important. And certainly the debt ceiling is really a political game that hopefully will be worked out without having government shutdowns and kind of the damage to the economy that can happen when you get real disruptions to the Treasury market or to the government itself.
Got it. I do want to shift because we've talked a lot about the economy, but I want to talk about the markets, and maybe let's do the big picture. Like, what is your overall assessment of the markets?
Yeah, so I've actually been recently, more bullish on equities and sort of risk assets in general than I've been in at least a year or more. The indicators, I mentioned, how I try to rely as much as possible on objective, quantitative indicators. And that's true both for asset allocation, kind of market timing kind of things, as well as stock selection. And a lot of what I'm seeing right now shows that risk appetite in markets is really improving quite a bit from where it was last year, certainly late last year. And that's been, I think, the key trend in markets is that the kind of the average investor, and certainly a lot of institutions that I talked to, were pretty pessimistic, kind of October, November last year. Most of them expected recession. Most of them expected, a lot of Fed tightening, and for that to have a really negative impact on earnings. A lot of people were expecting the Q4 earnings reports that have been coming out to be much worse than they were. They weren't great, but they were okay. And so I think the fact that things are not as bad as expected is producing a lot of the kind of better risk appetite that we're seeing in markets now. And I do think we are getting closer to the end of the Fed's tightening cycle. And historically, that's been a better time to be exposed to equities and to risk assets in general. That even though we might have another couple of rate hikes to go, we're much closer to the end than to the beginning, and the economy has held up relatively well in the face of that. So I would say that being a little more bullish on equities is kind of where I am now. I probably would not be in favor of bonds. I think long-term bonds have they priced in a lot of the potential good news from the Fed in the form of lower rates maybe next year. And so I think some mixture of equities and a bit of cash is probably the place to be. And that, it's probably okay to look at some of the cyclical areas of the equity market. I think earnings are going to be okay. They're not going to be great, but I think okay is really, again, better than what the consensus was. And I think that a lot of what's happening is that there's been a compression in profit margins, but not top line revenues and sales. And so I think once that process normalizes or adjusts, profit margins were very high, last year, and probably due to correct. They've done a lot of correcting already and probably do a little more. But I think the underlying drivers there are probably going to stabilize, and we're starting to already see that a little bit in the earnings estimates. So I think overall, I'm more positive on equities and on risk assets than I've been for a little while. And that's certainly what I've been writing in my research to institutional clients.
Yeah. So more bullish. You mentioned like cyclical areas are interesting to you. Like, is it overall equities that you're bullish on, or is it just specific areas? Like, what is what are the opportunities that are interesting to you or make sense to you in this environment?
Yeah, and I am generally bullish on equities, at least for the next few months. I tend to take things on kind of a rolling, 3-month or so basis, and kind of reevaluate continuously as we go along. But I think, I think some of the areas like consumer discretionary or industrials are areas that are, looking relatively better now. And even some of the areas within, say, technology that had been under a lot of pressure, certainly on a relative return basis in the equity market, and certainly some of the mega cap techs where the earnings had been under a lot of pressure. The earnings estimates have been cut pretty dramatically for some of them. That's starting to kind of, that headwind is weakening, I would say. And so I think we're seeing things that had been very negative turning less negative, and some of the things that maybe had been more positive getting a little bit more positive. And so in markets, certainly in my view, that's really the key, is kind of those turns from if it's very bad to being less bad, or maybe so improving. That's the direction is what matters rather than kind of the level. And I think those inflection points are what we're seeing right now, both in terms of the fundamentals, that the economic data is less bad than expected, and certainly even things like the economic surprise indices. Citigroup publishes these economic surprise indices that track whether the macroeconomic data is better or worse than what the economists expected on a rolling basis. And so those have been positive recently. So I think earnings estimates are going to be a little bit better than they had been. I think macroeconomic data is a little bit better than it had been, and that's enough to boost stock prices, which is what we've seen this year so far, and to kind of bring risk appetite back from the very low pessimistic levels it was at late last year. And I think that could go on for a while. Those kind of sentiment swings tend to play out over a period of months. They're not short-term, day-to-day, week-to-week things. So coming from a very low level of optimism, we're getting back to sort of maybe more neutral levels now, and could probably go a little bit higher in terms of investor sentiment before we'd run into a question of, well, are people too bullish now? And that, I think we're not there yet. Yeah. So I think while we're in the process of improving, you want to kind of stay on that bullish side and look for areas like industrials or consumer discretionary, and some of the technology areas that had been under pressure and are looking better now.
That makes sense. So your focus, like you do a few months, like I think you mentioned like 3 months, like that's when you kind of when you put together your outlooks, it's like just a few months out. I think it's important to distinguish.
That's right. I think trying to look out a year or two ahead of time and make big bold bets on that is very difficult. A lot can happen, certainly even in 6 months or a year, as we've seen. And so I think, and having objective indicators that kind of constantly update and tell you, what's happening now And therefore, what does that tell you about the next, say, 1 month, 3 months, maybe 6 months? That's probably as far as a lot of these indicators can really be relied on to tell you. And again, I'm talking to professional investors who have to manage money against a benchmark and are judged for it on, say, a quarterly basis. Most of them get, quarterly performance reports or certainly every 6 months, and they have to show, what they're doing on a shorter term basis. And if they don't do well, if they underperform, then, investors will take money away from them. And so there's certainly a kind of, time frame that a lot of the clients look at from, quarter to quarter, or, over the course of, say, 6 months, and certainly, up to a year, that they have to focus on in terms of performance. If you can say, oh, well, I'm a long-term investor and I'm thinking about 5 years from now, that's maybe great, but people might take their money away from you within a year if your performance lags. And so you kind of have to be at least somewhat focused on, the next, say, 6 months or so. And so I think keeping those timeframes in mind and trying to be objective about it and trying to dynamically adapt to what's going on is more important than sort of making a big bold projection at the beginning of the year and then never changing it.
Yeah.
So I think that's the trap. It's easy to fall into. It sounds better to say, well, I'm bullish for the next 2 years, or I'm bearish, but I think you got to adapt to what's happening, and again, try to rely on time-tested objective indicators rather than what's in the headlines.
Yeah. The ability to be dynamic and to adapt. You keep mentioning these indicators, like these kind of objective indicators, and I don't want you to have to give away like all your secrets or your methodology or whatever. Is there maybe the question is like, what's a really interesting indicator to you that you pay attention to, or signaling something, or maybe you want to reveal more, but maybe I could kind of phrase it that way, because I am curious, like, what are the indicators, or what's an interesting one to you?
Sure. So when I'm looking at indicators for sort of market timing, asset allocation, how risk on or risk off do I want to be? I kind of think of there's two types of indicators. One are the indicators directly tied to the equity market itself. Basically our stock price is going up or down, and what is volatility doing? Is it higher, rising or falling, and things like that. And what kinds of stocks are people buying? So that, are they buying the risky stocks, the high volatility, go-go stocks, or are they buying more defensive, conservative stocks? And those have been improving. Everyone can look at the S&P 500 or the NASDAQ or any of the major indices and see that, well, yeah, they've generally been rising this year, and it's been more of the the growth or the riskier stocks that have been leading. So that's a good sign. But most people are used to looking at that, and that's pretty common. The other kind of side of it, which is potentially more interesting, are the non-equity indicators that corroborate what you see or sometimes don't. So there I'm looking at credit. So, credit spreads, meaning the difference between what corporate bonds yield and what treasuries yield, as a measure of how much credit risk people think there is, whether companies will be able to pay off their debts, and what the defaults might be, those kind of things that are tied to the economy and tied to earnings, but are not directly related to equities themselves. There we've been seeing improvement. Again, toward the end of last year, credit spreads have been widening, meaning people were demanding higher yields on corporate debt than they were on treasuries to compensate for the risk that we go into recession this year, and companies would have to have trouble paying their debts, particularly the lower rated ones. And we're not seeing that now. We're seeing investors being willing to take somewhat lower yields on corporate debt. And so that kind of tells you that we're not in a situation where people are worried about corporate balance sheets and companies not being able to pay off their loans. The other thing that's interesting is metals prices. So industrial metals like copper or aluminum or zinc or those kind of things that are made, they're used in housing or auto building, anything that's kind of an industrial goods producing thing, and that are global. So again, not just the U.S., but China or Europe or emerging markets. All those things are tied into the global commodity prices, and particularly industrial metals. So that's a much more sensitive indicator of what's going on globally, and tends to track what people's perceptions are of potentially in China and anything that's related to manufacturing and housing. And so those prices have been doing a bit better recently. So you've seen an uptick in copper prices and things like that. So that's another way to say, okay, are global growth expectations improving or weakening? And so that's another way to look at it, not just from the standpoint of equities directly, but from a kind of a cross asset standpoint. And so most of those metrics are favorable now, more favorable than they've been the way I look at them. Again, they're looking more at if they were negative and they're less negative, or they were slightly positive and now they're more positive, that kind of thing, that kind of second derivative, rate of change is really what they're focused on. And that's kind of what I'm seeing improve recently. That's why my model is more bullish, and why, therefore, I'm following along and getting more bullish.
Yeah. And it's just so interesting to like, when you unpack it, almost so different like components, and it almost sounds like putting together like a bit of a puzzle too. That's just kind of like my view of like, it's so interesting to hear like what you look at. It's cool because there's a lot that goes into it as well. I want to hear your thoughts, because you did bring up, okay, so like why you explain like why you're a bit more bullish on equities right now. I want to hear your thoughts on bonds. Your thoughts there, how you feel about like, I mean, bonds is huge. Like there's so many different facets of it, but like, let's start with like big picture on bonds.
Yeah, I think bonds, I guess to say up front, I've been underweight bonds in my kind of asset allocation recommendations, meaning if normally you would hold, say, 30% of your portfolio in bonds, or 40% or something like that, I would be less than that. Now, not to say you wouldn't own any bonds, but just that bonds are less attractive now than probably they would be under normal circumstances on average. And I think a lot of that comes down to the big thing in the bond market right now is the yield curve being heavily inverted, meaning that the long-term bond yields are lower than short-term yields. So you can get more on holding a 3-month or a 1-year treasury bill than you can on owning a 10-year treasury note. And I think that reflects a lot of what people expect for Fed policy. So the short-term interest rates tend to follow Fed policy much more closely, of course, whereas long-term yields can move around more. And they're assuming that the Fed will stop hiking rates sometime this year, not sure when, but sometime this year, and then start to cut again, either late this year or next year, as the economy slows down, inflation comes down. And so they're already pricing in a fair amount of that effect. If the treasury yield, 10-year treasury yield is around, I think, 3.8% or so today, and the federal funds rate is 4.75% and probably going to go to 5% next month, you're giving up a significant amount of interest income by owning a 10-year bond than owning a 1-year or 2-year bond, in anticipation that the rates will come down later. So the risk there is that rates don't come down as fast as people think, and then you've taken the lower yield, and there's not much more to get from that in the sense of yields going down further and giving you a capital gain on your bond holding. So I think the inverted yield curve makes it more difficult to own long-term bonds now, relative to, say, short-term bonds or cash. And so you have to have a very, very strong view that inflation and interest rates and policy rates are going to go down fairly quickly, more quickly than the market already anticipates, in order to make bonds attractive to own, say, over the next, again, 3 months, 6 months, or a year or so. And so, if you're going to hold a bond to maturity and you're happy with the yield, fine. Then it doesn't really matter much. You can just, do that by itself. When you're thinking about asset allocation, are stocks going to give you a better return than bonds, or is cash going to give you a better return than long-term bonds? I think the relative kind of asset allocation standpoint looks better for equities, like I say, but better for shorter term duration assets and bonds than for longer term. Because, like I say, a lot of the good news is already kind of in the long end of the bond market right now, and therefore there's not a lot of upside there from my standpoint.
So it's not a lot of upside. It's not like problematic when people like don't want, or maybe I don't know if that's even a good question, but it's not like a problem if people like don't want to own bonds right now, right? Or like the longer term bonds. It's not like a big deal, is it?
No, I think there's still, kind of structural demand for fixed income. I think, the demographics are people are still getting older, and people still want, income in their portfolios. And certainly now you can get more yield from treasuries and most fixed income than you could for much of the last, say, 15 years. So, that's, I guess, good in the sense of if you're looking for income, it's easier to find now. but it's more, again, that kind of just a relative allocation view within a fixed income portfolio or within an overall, stocks and bond portfolio. Kind of which do you want to give more emphasis to? There always is going to be demand for bonds, and I think the Fed certainly can have a lot of impact on that with their policies, and so I think there's no danger that people won't want Treasury bonds or any bonds. It's just a matter of exactly what yield you're going to require, and kind of how you feel about inflation, kind of potentially eating up some of the the real value of those income payments that you're going to be getting. If you think inflation is going to be higher than 3.8%, wherever the 10-year Treasury is paying you, then it's going to look unattractive to you. If you think inflation will be much lower than that, then it will look pretty good. So, like I say, a lot depends on what you think about inflation to say whether you think bonds are appealing right now. I don't necessarily think inflation is going to be super high. I just think that a lot of the good news is probably in it for now. Again, on a 3 to 6 month view.
Yeah, that makes a lot of sense. And the key word too is relative too. Is that, yeah. Okay.
Very much.
That makes so much. This is why it's so great to have you on. Because look, I am definitely not an expert. I get the privilege to talk to really incredibly smart folks like yourself and learn and help my audience learn as well. So that's just awesome. Okay. Another question for you, because you brought up the inverted yield curve. I had a guest on recently. It was the episode with Michael Howell, who's known for, he's an expert in all things liquidity. And he made a case on the show that it's a flaky predictor. A flaky predictor of a recession. Like some folks think yield curves, when the yield curve inverts historically, like it precedes a recession. What are your thoughts on the yield curve? And do you have any, or do you pay attention to that, or like think about that, or is it an indicator you ever look at? What are your thoughts there?
Oh, you're absolutely right. I mean, in terms of indicators of recessions that are widely used and followed, the yield curve is probably top of the list. And it is true, in many historical cases, an inverted yield curve did precede a lot of the recessions that we've seen historically. And the message from an inverted yield curve usually is that the Federal Reserve, the policymakers, are over tightening. They've gone too far with short-term interest rates and they've slowed the economy too much. And that's what's going to cause a recession and lower inflation, and therefore lower interest rates in the future that the long-term bond yields are anticipating. Now, the question this cycle is, I guess, partly the kind of post-COVID volatility that we've seen, that this is an unusual cycle compared to all the past cycles. And so it's hard to interpret yield curves or a lot of other economic data, like I said earlier, in the light that you would normally look at it historically. The other is that, like I say, there's monetary policy. And so even if you think monetary policy might be too tight, there's fiscal policy on the other side. And so a lot of what's happened in the past is that fiscal policy did not counteract monetary policy and keep kind of, a balance in terms of the economy. If that is not the case this cycle, meaning if fiscal policy does, remain relatively supportive, that can at least partially neutralize the effects of the yield curve being inverted. And, the other thing is just, the dynamics of the way the markets work, and the fact that the Fed is doing more balance sheet activity now since 2008 than it did in the past, meaning it's buying long-term bonds, which it never used to do, and trying to really manage it's the number of bonds it owns, but the type of bonds it owns as well, and that has more effect on the yield curve and the relative dynamics within the Treasury market than was the case prior to 2008. So a lot of the history of the yield curve is based on times when the Fed was not doing what it's doing now, or what it's been doing since 2008. So it's harder to interpret it the same way because monetary policy is being done differently now. It used to be that reserves in the banking system were kept at a low level, and the Fed would use interest rate policy to adjust reserves much more dramatically, and really didn't do much in the long end of the yield curve, and didn't buy 10-year treasuries. And certainly didn't buy mortgage-backed securities and things like that. Now they do, and that has knock-on effects for how the yield curve behaves. So I think there's a lot of things that are different this cycle, both in terms of COVID and all the knock-on effects from that, and also the way the Fed drives policy. And I think that's had an effect on the yield curve that may not mean we're going into recession. The other thing to keep in mind, of course, is that the yield curve may predict a recession, but it's not real good about when. Meaning it might be 3 months from now, it might be 18 months from now. There's a wide range historically in terms of when the economy actually starts to really go into recession based on a yield curve signal. And even then, which yield curve signal are you using? There's a lot of different ways to measure the yield curve. And not all of them have given the same message recently. So I'm certainly aware of it and looking at it, and it does inform my relative bond allocation decision, like we were talking about a minute ago, but it doesn't necessarily tell me, oh, we must be going into recession right now, because I think there are a lot of other factors that play into that you don't want to rely on that one single indicator, because again, there's a lot of play in the timing of it, and there's a lot of things that are different, the way the Fed operates now than in the past.
Yeah. Well, Sam, I have to say I've really enjoyed listening to you and learning from you. And I'm really grateful that you came on the show. And I want to give you just a couple minutes, for any parting thoughts. If there's something that we didn't bring up in the conversation that we should have, or just a thought that you might want to share with the audience, and also let folks know where they can find you, whether it's following you on social media or, finding more information about your firm or the research that you put out. So just take the next couple of minutes to do those things.
Oh, sure. No, and I really appreciate it. And I think, the main thing from my research standpoint is to look at a lot of data and a lot of indicators and look for where they line up. That's kind of what I try to do. And so people who, follow me on, on Twitter or on LinkedIn, where I try to post fairly frequently to give, excerpts and kind of highlights from what I publish for institutions, is to look for a lot of different indicators and look for where they align. And so if you go to, millstreetresearch.com, you can see samples of all the research that I produce there, where you can read about both the macro kind of portfolio strategy, economic work, and also the more stock selection, industry sector kind of work that I do, based more on earnings estimate revisions, price trends, and valuations for stocks and industries and things like that. So I would say, if you're interested in either of those two things, you might want to have a look. I've recently started publishing a new report that's more for the kind of a general audience, for individual investors or maybe investment advisors who want to get a better look at the work. It's called the Weekly Roundup. It's basically kind of a carve out of what my asset allocation, economic, views and some stock selection that are carved out from the bigger institutional research platform that I provide to institutional investors. And so you can go to the website and find a way to subscribe to that. And so, if you want to get a closer look at it, that's probably what I would do. But yeah, millstreetresearch.com, Mill Street Research on Twitter and on LinkedIn are all ways that you can see kind of what I'm, doing, what I'm saying. And certainly you can find the contact form or, info@millstreetresearch.com if you want to email us and get more information.
Well, Sam Burns, Chief Strategist at Mill Street Research, really appreciate you taking the time and being so generous with your thoughts and your ideas. Thank you so much for joining me today. Really, really enjoyed this conversation.
Oh, my pleasure. Thank you for having me.
Hey everyone, I really hope you enjoyed that video. Be sure to hit that like button, the subscribe, and that bell so you won't miss any new videos.